Welcome to the B.F. Anderson Technical Report for February the 15th. We've got a lot to cover here. Let's get right into it. Louise Yamada, very smart lady, top analyst. She's got to be in her 80s now. She's been around for quite a while, but she was on a recent interview with Bloomberg that caught my attention. First thing she talked about was the fact that interest rates, since '09 have basically plummeted. Interest rates got down to levels we have not seen since the Great Depression. What this, in her mind, indicates this is deflation. That you can use the 2-year. This is, by the way, this is the 2-year U.S. Treasury yield, and that it has been discounting deflation for a very, very long period of time. But all of a sudden here, we're starting to get an upturn in the 2-year Treasury note yield, which she believes is starting to indicate that we are exiting deflation and we're now going into inflation, which can be a good thing because inflation is going up because the labor markets are tight, which means we have full employment. So you got to remember that most of inflation is the cost of labor. Now, 3% is the magic number, so she believes that, not immediately and not right away, but we are probably going to end up at 3% on the 2-year Treasury note. Now, she also talked about the S&P 500, and she was talking about how, we really kind of got ahead of ourselves up here. As you can see, there was just basically a parabolic up move in the index. We then had an 11% correction here in February and seemed to have stabilized. Now, Yamada is of the opinion that the long-term trend line that started back in '09 is still intact. So she believes that we actually held the 200-day moving average. Now here's the 200-day, and also here is the consolidation from where the breakout took place. So we've pulled back, normal pullback within an ongoing uptrend. This is very good news. It just basically is saying that we're still in a bull market. We just had a normal pullback to cool things down. Now, I did want to bring back in something of my opinion, which is the Value Line Geometric Index, which is a very good index to keep an eye on. Not many people know about it, but it's 1,700 stocks. It's a broad index. It's equally weighted. Now, we have gone through an extensive bear market here. This has been a real difficult period. This has lasted for 20 years basically, and we would make a high. Now here's the high in 2000. You can see the topping formation. Now I'm using here the 35-week moving average compared to the 50-week moving average, just to give you an idea of what that kind of top would look like. So here's a topping process. You're breaking down, you're getting the death cross. You make lower low, lower high, lower low, lower high. So that's a downtrend. Then we get back to '07, same basic problem. And you can see the breakdown. Now, as you know, back here between the years of 2014 to 2016, up until the election, we went into somewhat of a mini bear market. But if you look at the index as of now this is basically as of last Friday because of being a weekly moving average, but the currently it's at 553, which is actually up here. So this particular formation looks nothing like the tops that were formed back in the prior bear markets. So according to the Value Line Geometric Index, which measures the average stock, and using two very simple moving averages, you can see that this looks nothing like the prior tops that we saw back in the last 20 years. Now, I went ahead and did another indicator, which is a monthly indicator on the same index, the Value Line Geometric, 10-month versus 20-month. This is the 10-20. You can see the problems here, but then again, you can see that we are on a bullish cross, and really everything looks fine. Now, I wanted to also get a little bit into what's going on in the bond market. Now, this is a graph of the 30-year U.S. Treasury bond price on a daily basis using the 25 and 50-day moving average. Now you can see that the price of bonds is basically plummeting because interest rates are going up and inflation is picking up, and that's bad for bonds. So you can see here that in this particular situation, bonds appear to be in a bear market. Again, back to the 10-20, which is a more long-term indicator, and if you realize that the index as of the end of last month is currently down 142.38, so the index is actually down here. Now all I have here are two moving averages, the 10 and the 20 month. We've gotten the death cross. Again, this confirms the fact to me that interest rates are going up and bonds are going to continue to decline. Back to just another graph that I wanted to mention, that Bill Gross of Janus Henderson, who's a longtime bond manager, has also stated that the bear market in bonds has begun. Now, as this correction has gone its way, I monitor five U.S. indexes, of which only really one index, which is the NASDAQ, has gotten back above the 25-day moving average, which tells me that, we don't want to rush too much here. We did get somewhat defensive, but we're of the opinion that perhaps this correction has ended. But I thought it was interesting that if you take the emerging markets ETF and you look at what's happened here, it has really come out of the gate the strongest. So it looks like the emerging markets, and then if you look at China, which is the PowerShares Dragon ETF, it's actually almost back above the 25-day moving average. So as this correction has completed and is starting to recover, the international stocks, meaning Latin America and Asia, these areas look to be the strongest. Now we go to the top five. AbbVie, which is biotechnology, continues to make the list. Let's see. Here's Global Blood Therapeutics, another biotech. They're into blood testing. Again, it continues to hold above the 25-day moving average and continues to be strong. Now here is a very interesting company we've talked about before. This is Match Group. This is Match.com, the dating service. This stock is just smoke up a chimney. It is doing incredibly well, and it brings you back to the concept of e-commerce and different ways that e-commerce are going to benefit. Now, Netflix, I must say, we have taken a position in Netflix. Netflix, during the correction, held up incredibly well. That's the reason I'm taking a position in it, is that it held up much better than the overall market. It basically held the 25-day where everything else was breaking the 50-day. We had a nice earnings gap here. The company announced its earnings about 2 weeks ago, and the greatest amount of growth for the revenues of the company were international. So that kind of ties back into the fact that the Golden Dragon, which is Asia and Latin America, seem to be doing well. Netflix somewhat confirms that because the greatest amount of growth that they had for the company was in their international markets. This concept of streaming videos is really, really catching on. Now, if you also think about the business itself, when you look at a profit margin, what really impacts profit margin more than anything? Well, you got to look at labor, you got to look at inventories, you have to look at regulations. There are just many things that you can look at that determine whether or not a company has a very high profit margin. And so with Netflix, it's just another one of these e-commerce companies, somewhat like a Facebook, where they really don't have a lot of overhead and their profit margin is substantial. Now here's an interesting situation that has popped up, which is Twitter. You can see here, big gap up. Now this is what President Trump has been using to communicate with the country. So the main message here is this. It looks like we've had a 11% correction, which is now starting to stabilize. And if you've got fresh money, this would be a very good time to be putting money into the market. Let me know if you have any questions. Thank you.